Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's August 7th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Let's start with the elephant in the room. The big market sell-off, which started on Friday, thanks to Donald Trump, who sent out a tweet saying that the U.S. is now going to levy 10% tariffs on an additional $300 billion of Chinese imports. This kind of surprised a lot of people in the markets, which started to crash after his tweet, right? We thought everything was going along smooth and they were meeting and everything was fine, so it was a surprise. The markets were up a few hundred points midday Friday, right before the tweet. And then after the tweet, they sold off hard, falling more than 500 points from its highs. Did rebound a bit on Friday. You know, talking about the Dow here. But then came the fireworks on Monday. The market started selling off again, falling 800 points on the day. So to begin Monday, pre-market, stocks were down about 300 points, opened up, and then during the day, it was just key technical levels that were breached. The algos kicked in, and before you know it, the whole world is selling. We're down 800 points of the news that basically happened midday Friday. So the sell-off sparked a few emails from you asking if you should go into cash now, just off of this sell-off, even though stocks were literally at near all-time highs a couple weeks ago, heading into earnings season. I expect that. People get nervous. They watch TV. It's all crazy. And you know what? I responded to almost every one of these people. It wasn't a lot. It wasn't that many people. But I just responded and said, hey, you know what? Shut the TV off. Stop reading anything financial related and go hang out with your kids. Or do something fun. Because all this is just BS. It's not going to impact the long-term outlook on the markets at all. And that's what you should be focused on long term. Now, before you, I'm referring to my listeners who do not like my opinions on trade, you may want to fast forward. But before you fast forward to the interview, which we have a great interview set up, guys, today. It's a first-time guest. He's awesome, and you're going to love. But before you tune me out here, seriously, just give me a listen. Because I promise I'm going to make a lot of sense. Promise you. And just to show that I'm not a hypocrite, I've been a little critical of Kyle Bass because he's been bearish such a long time and wrong. I respect him, though, because he puts his money where his mouth is, unlike a lot of other notable bears who have become rich over the past 10 years, despite everyone they give advice to are flat out broke. I won't mention names. But Kyle Bass got on CNBC yesterday and gave his opinion on trade. I had CNBC muted at the time. By the way, I'm telling you guys to shut off CNBC. I watch it because it's the best way to gauge sentiment in the markets. And they have some good interviews on there. But, you know, maybe you just want to shut it off during those extreme times because it gets a little crazy. But anyway, I have it on mute and I see Kyle Bass' name across the screen. I'm like, here we go. Mark's down 800 points. He's a bear. I wonder what he's going to say. But he started talking about trade. And man, I love what he had to say. He was like, look, I'm not a Trump supporter or even voter for Trump, but what he's doing is right and important. So China claims to be at 15% of global GDP in dollar terms, but less than 1% of global transactions settle in their own currency. What does that mean? It means they have to support their own currency and need dollars to do it. Basically saying you better stop playing hardball. He also talked about China and U.S. negotiations. So last year, where were we, right? It's been going on for about 2 years now. They promised to buy agricultural products for us, stop stealing our intellectual property, make trade fair. They said all this, and they did nothing, right? So what do? We levied tariffs on their goods, and that's what started the so-called trade war. People love using a trade war. It's not a trade war, guys. I'll explain why it's not a trade war. Relax. Now, fast forward to today. And there's been some, ups and downs in trade and whatever. Almost every sell-off I said, look, this is nonsense, buy stocks, and it kept going higher and higher. Now we're back again, right? Because what are we seeing? Well, the current round of negotiations, which took place in China last week, with delegates from both sides present, China said, when they sat down at the table, they said, before we engage in talks, you, meaning the U.S., has to drop all tariffs on goods right now, stop disallowing Huawei to sell goods to the U.S., and release the CEO of Huawei. So China said, that's the first thing they said when they sat down, right? Engaging in talks. And we said, basically, go F yourself. China delegates got up and walked away from the table. Literally just got up, walked away. So our delegates reported to Trump, told him what happened. And Trump said, hey, okay, if that's what they want, then we know what we got to do. He came out with that tweet, levied another 10% in tariffs on Friday, or an additional $300 billion worth of goods. And that's 10% tariffs, which I think would trigger September 1st or something, early September, if they don't come to terms. Now, I know this is going to be difficult for some of you to comprehend. And I get it. I really do, because emotions are crazy high these days. And people have strong opinions, social media. It's so much easier to say stupid shit when nobody knows who you are, or you're not face to face with someone. I mean, that's our world today, right? When I grew up in Queens, you said something to people's face. If they didn't like it, you got into a fight. Now you can say whatever you want, your way, and you get more aggressive because you're not in front of people, but you would never say the things on social media that you would say in person. No way. But emotions run high. Just look at your Twitter. Just look at Twitter. Look at Facebook's a little different, family oriented. I mean, Twitter, it's 80% of the posts are angry, negative, people pissed off. It's the way it is. So I get it. I know emotions are running high these days. But I'm talking about something a lot different, because this podcast is about investing, about helping you make smart investment decisions so that you, your kids, and their kids can be secure. I'm talking about creating generational wealth. That's why I have this podcast. I think that's why most of you listen. But that's the goal. When it comes to politics, I don't care which side you're on. I don't care who you like, who you hate. So put your emotions aside for just a minute, and let's talk business. Because what Trump is doing on trade is right. China has been stealing from us and taking advantage of us for decades. We let them steal our intellectual property and never did anything for decades and decades. We allowed them to jump to cheap commodity, cheap steel on our markets, which crushed the industry and resulted in thousands of people losing their jobs. This stopped under his presidency. Just look at the data on this, which I provided my tariffs report, which still a lot of people downloading. Free, by the way, available on our site, CurzioResearch.com, if you want my opinion on trade here. More details. But China has a massive trade deficit with us, which doesn't have to be that big if they just bought maybe some of our cars, soybeans, natural gas, agricultural products from us. These are facts. Not debatable. And something needs to be done to stop them. Right now, we have employment near record lows, a stock market at historic highs before this pullback, consumer spending very strong, housing market pretty stable and getting better because interest rates going lower, mortgage rates are lower, more people are refinancing, buying houses. But now's a perfect time to do this, right? When the U.S. is in a position of strength. And again, I'm talking business here because picture this. Picture your Apple. And nobody really cares about it. You don't care about Apple. I care about Apple because, with earnings and stuff like that. But you just use their product, their iPhone. It's awesome. Their iPad, the Mac, you use all the products. It's cool. And have fun and tweet and laugh and whatever, right? But behind the scenes, Apple, and you could go into Walmart, Comcast, all these large companies, just choose one. They control their suppliers. They do not let their suppliers dictate terms with them. No, they've earned that right because they're huge and everybody wants to deal with them. If you sell a product, you'd like to sell it in Walmart. Yeah, your margin would be a little low, but you'd make it up on volume since it's the biggest retailer in the world, big box retailer. But if you're going with Apple, you're not going to let, Apple's not going to let their suppliers dictate those terms or have, say, Skyworks, Areva, Micron, Texas Instruments, whatever else. I can name 30 companies right now that have stuff in iPhone. I've covered this. But you don't have these chip companies saying, hey, you know what? You need to buy our products, our chips at, say, whatever, $100 each instead of $50. And also, we're going to run a deficit with you forever, Apple. That's what we're going to do. All right? So we're not even going to pay you right now. We'll pay you a different time, and this is what we're going to do. And by the way, Apple, we're telling you this. We're going to try and steal your intellectual property every single chance we get. You know what Apple will say? They'd say, fuck you. We'll use other suppliers who are lined up around the block to service us. They'll help us lower costs and generate more profits. That's what we're trying to do with China. It's that simple. If you're a business owner, which I know so many of you are because you email me, if you're a business owner, would you do business with a company that's stealing your intellectual property? No matter how big that company is, you would never do it. That's your intellectual property. It's the biggest asset for your company. So those of you saying that the U.S. is wrong for calling out China and going through all this stuff, either have an agenda, they're trying to win an election, or they're just complete idiots and don't care about the data. What's even crazier, that's a word, crazier, is that there are experts that I constantly see on TV, or so-called experts. It's funny how they label themselves experts. I think it's great. That believe the U.S. will be in worse shape than China if we have a drawn-out trade war. Let me tell you something. China is done. Sell China right now. Because even if they negotiate a deal, the damage is already done. Companies are moving their supply chains out of China. You're seeing that with the numbers. And companies are basically telling you this on their earnings call because they don't like that uncertainty. They need to get out of there. They're going to move their supply chains, a small part of them, until they get all their supply chain, wherever, because they don't want that uncertainty where they're not going to be able to measure their costs. It's almost like Walmart or Target, some of the biggest retailers who have trucking fleets not locking in or even say airlines not locking in the price of fuel. Imagine if you don't lock in the price. How do you dictate how much you could spend CapEx unless you lock it in the futures market? You don't want that uncertainty. You don't want to have things going great and all of a sudden oil goes to $130, $150 wherever, and now you want to lock in your costs. This way you have a 3-year plan of here's what we have to spend, here's what we're going to buy new planes, we're going to buy new trucks. That's what companies are doing. You're seeing it in data, and they're telling us this. So they're removing stuff out of China already. But let's just say that we don't come to terms with China, and this gets drawn out long term, right? Let's take a quick look at the numbers. Because China shipped nearly 20% of its exports to the U.S. last year. We're by far their biggest customer, outside of Hong Kong, which is basically China. But the next biggest is Japan, which is 6%. I think South Korea, Vietnam, like 5%. They have how many countries, to fill in the gap. Now, if we decide not to trade with China anymore, which is never going to happen, but let's use an extreme case because these days that's all you hear in the media, right? That's all you hear. That's all the media. It's extreme cases and what. So let's go really extreme, right? Pretend with media right now. If we cut off China, who are they going to sell their products to? Who are they going to sell those specific products to? We account for a 20% customer. How would they make up the difference? Given that we're the largest consumer in the world, we're the highest personal consumption expenditures per capita, which is a fancy way of saying that U.S. consumers like to spend a shitload of money, more than anybody else, almost more than anybody else on things. They just love to spend. That's great for someone selling products into our market. But how are they going to make up that difference? Please, somebody tell me that. And remember, China's economy is already weak. Its housing market is in bad shape. Massive debt. Consumer spending is weak. Look at the numbers. It's like a black hole. Now, imagine taking away a 20% customer from your business. What would happen to your company? And considering that 20% customer would be the difference between you reporting a profit and a loss every year, or basically having a decent business, or having to go bankrupt and fire all your employees. A 20% customer. Now, if you're the U.S., you can buy these goods almost anywhere. Who wouldn't want? People are going to be producing these goods like crazy. Imagine if someone said, hey, we're going to spend hundreds of billions of dollars with you if you could find a way to create these products at the cheapest price. Well, China's been that country, but now it's going to be Taiwan, Vietnam, and other countries will line up to pick up the slack. And yes, it may cost us more, which would pressure margins a little, and maybe create a little inflation, which is not the worst thing. I mean, the Fed's been trying to do that for 8 years and has been unsuccessful. But everybody's so worried about inflation right now. But we can get goods from anywhere. Anywhere. You can't sell them to anywhere, but you could get them whenever you want. If you're willing to pay for something, people are going to create, they're going to make it. And I'm sure they want to deal with the U.S. because having a good trade partner comes with a lot of benefits, different things that you could do behind the scenes. I won't even go into that. So if you look at China, they have so much more to lose here. And they're absolutely crazy for playing hardball. I mean, you want proof. Listen, if you think I'm crazy, just look at the stock markets. Guys, pull it up. You go to Google, go to whatever charts you see, whatever chart you have, and just pull up like the U.S. stock market compared to China's. And look at the differences on what happens when negotiations break down. I mean, you're looking at China selling off more than 2x than us, much more than us. And when things start looking good again, China rebounds tremendously, moves almost at a 2x pace above ours, right? That means they're more leveraged. They have much more to lose and also to gain than us. Now, going even further here, for all those who think our trade fight with China is an end-of-the-world event. It's an end-of-the-world event. Holy cow. It's just trade wars. I just laugh when people say trade. We're not in a trade war. It's okay. This is negotiating tactics. I mean, if you look at the numbers, an extra 10% in tariffs on $300 billion in goods amounts to $30 billion. The U.S. economy is $20 trillion. China is what, 13, 14 trillion? All right, so this amounts to what? Less than 0.2% of the U.S. economy? It's nothing. It's nothing. What you need to know as an investor is tariffs are a way of communicating. This is how we communicate with China and how they communicate with us. I know you say, well, Frank, look at the market sell-off. It's accelerated. I mean, the market was selling off on Monday, 800 points, right? So you're looking at the markets, and I have access to a ton of amazing research, even from technical analysis, and seeing the technical levels that will be broken. Kind of when the market opened, there's a lot of people, the smart, I'm not saying people are smart or whatever, but the algos are going to kick in. Certain levels are going to get hit. And the people that I spoke to that I know best who are really great in the markets, they knew the market was going to sell off a lot more than that. They start coming. They see it coming, all the algos start triggering or whatever. But this is on news that happened on Friday. And again, it's an overreaction, right? It's all behavioral. We're going to talk about that with my guests later. If people get scared, they sell or whatever. Then you got the algos who don't care about companies or anything. They're just, looking at market triggers and getting it ahead of everybody else and selling. Again, they don't even know what companies, what they do, whatever, but they're just trading in and out of it. But the bigger deal here with all this communication, everything, is we want China to stop stealing our intellectual property. We want them to lower the deficit by buying our goods, like agricultural products, whatever, natural gas, cars. And they refuse to. They continue to lie to us and not follow through on what they're saying. I mean, it's very, very simple. And there's a stubbornness there, and maybe they don't come to terms with us. But if that's the case, I think it's kind of important to swallow your pride because China's economy is going to be in shambles. I mean, it's already crashing, and they basically undo all the growth they've seen over the past 15 years. If they're going to, again, extreme example, lose us, which they won't. It's not a trade war yet, guys. This is communication. Don't fall into a trap and watch everything on all the media channels. Again, their job is to scare the crap out of you. This way you're watching. This way they generate more money off their commercials. That's their goal. Their job is to get viewers. How do you do that? You don't say, well, this isn't really a big deal. Because nobody can. No. This could escalate. Last time we had a trade war before World War II. Look what happened. They say that's the cause of the World War. So it's so easy to scare the crap out of people because your message gets sent to everyone in seconds all over the world. But just take a step back a little bit. They're communicating. It's okay. We're coming off highs, all-time highs. We're down a little bit. Maybe we pull back a little bit more. But just put things in perspective. Because if you're looking at China, they have a lot more to lose than us. So doing this segment here, I know most people don't like Trump. You think he's a racist, chauvinistic pig, a lie, whatever. But put your personal feelings aside because Trump on trade, on this specific subject, is dead on. And this will work out for us in the end, despite what the experts in the media are telling you after the market falls 800 points in a day. Again, their job is to scare you. I mean, how many times do we have to hear this since China and U.S. have been fighting about trade for, I mentioned about pretty much 2 years now? How many times do we have to hear how the U.S. is in big trouble? The market's going to crash. I know I heard that at least 7 times over the past 2 years after every initial sell-off in the market. And every time, smart investors use it as a buying opportunity and stocks roared to new highs. We're back at the same scenario again. And later in my educational segment, I'm going to tell you how to position yourself again to make some big returns over the next 6 months as trade war tensions are likely to die down again. Unless China wants to destroy its economy, I still don't see that. And the market will push back to new highs again, probably over the next few months, which sounds crazy, but the last 6 times the S&P 500 fell by more than 3% in a day, this is dating back 2015, the S&P 500 popped an average of more than 2% 3 months later. Pretty cool stat. Thanks, Evercore. Research for that. But I see the market hitting new highs definitely before the end of the year and into next year with the Fed lowering rates, which they have to do regardless of data, since the current rate is 2.25%, which is much, much higher than the U.S. bonds, which are yielding 1.7%. I mean, it suggests that more rates are going to come. You know, Trump's going to do everything in his power to keep the economy strong and drive stock prices up. You may hate him, but he's heading into election year. And you know, people in the past, when you're looking at they vote with their wallets, they'll tell you, you know, anything they want to tell you of how they hate everybody. But if you have more money in your pocket, that's the way they're going to vote. That's how people vote. That's been proven for a long time. So Trump's going to do everything he can, whether you agree with it or not. I'm talking from a financial sense. Okay, feel free to frankcurzioresearch.com. Whenever I talk about this, I get tons of emails about how could you like Trump? He's a racist. He caused all the shootings last week. It's because of all this garbage and nonsense. This is about your money. That's why you listen to this podcast. But not only that, if you don't think stocks are going to go high, look at the companies buying back their stock. Over $1 trillion this year is going to be, they're going to be buying back. S&P 500 is going to be buying back $1 trillion in stock. I mean, you combine that with the around 2% yield, you're looking at a full yield between buybacks and dividends of 5-6% of the S&P 500. And I can tell you, it's going to lead to much higher earnings and much higher than most experts are forecasting. And we've seen that almost every single earnings season. Earnings are beating the estimates almost every single time when you look at the S&P and the total. I told you guys how to do that. Go to FactSet, Google FactSet earnings. Every 5 or 6 days, they come out with a full earnings report. It's like 15, 20 pages long. It's amazing. Just telling you everything, forward, all this stuff. It's fantastic. It's awesome. It's for free. Just Google it. Great information for you. But when I'm looking at the buybacks, plus, you know, people talk about, recession. They love that word. People love that word. Recession is coming. It has to come because this bull market, it lasts so long, and based on history, we usually have a recession every 6-7 years, and this is one of the longest bull markets ever. Right? So people love throwing around a recession, but lower rates are leading to a stronger housing market. We're seeing that data now. Consumers are still spending like crazy. Unemployment is still near record lows, while stocks are trading below their 5-year average based on forward earnings. I don't see a recession over the next 12 to 18 months, or through the time that the election comes, 2020. So guys, that's how I see it. Again, my educational segment, I'm going to dig in and tell you guys exactly what to look for, what you need to, because there's a lot of great stocks that reported awesome earnings, raised their guidance. They're down 15, 20% over the past 2-3 weeks. Small caps especially, which have gotten murdered. I'm talking about companies that also reported really good earnings. The difference between the S&P 500, and this is based on performance, and the Russell is at its widest gap, you know, based on a percentage in over 10 years. Usually small caps tend to outperform large caps, especially during bullish times. But the start of this year has been horrible for small caps. You're seeing some amazing opportunities, some great opportunities, probably more opportunities I've seen the last 2-3 years. And in my educational segment, I'll break that down. Moving on, I have a new guest today I'm going to interview. His name is David Keller, who's a president and chief strategist of Sierra Alpha Research, also a chartered market technician. One of the best analysts when it comes to behavioral analysis, which we're seeing a lot of, right? It's a big part of volatility in the markets. But he combines that with technical analysis and data visualization to find the best trading opportunities for investors, opportunities I'm hoping that he's going to share with us today. But David is a big shot. Previously managing director at Fidelity. Yes, that Fidelity with trillions in assets, where he managed a technical department. He writes for Bloomberg Magazine, has lectured about technical analysis all around the world. He's also currently a member of the American Association of Professional Technical Analysts and a member of the International Federation of Technical Analysis. So pretty amazing background experience. So buckle up, because it's going to be a fantastic interview. You know what? Let's get to that interview with David Keller right now. David Keller, thanks so much for coming on Wall Street Unplugged.
Absolutely, Frank. I'm looking forward to it.
Yeah, so I'm looking forward to this too, because you have a background and you study behavioral finance, behavioral analysis, and I guess we could start off. Let's get everyone involved, my audience. Could you explain exactly what that is, including, how do you measure it? But I'm sure a lot of people, let's get everyone on the same page, because I got a lot of great questions to ask.
Absolutely. The way that I always describe it when I'm working with my clients is that I try to help people make better decisions. And with investing, it's better investment decisions. But what's funny is that as you unpack behavioral biases, it's essentially all the stuff that gets in the way between you and a really good decision about your money. You make a lot of decisions during the day, not just with your investments, but what milk you're going to buy, what car you're going to buy, where you're going to live, and again, the same issues that cloud your financial decisions cloud a lot of your decisions. So a lot of what I do is just try to help get through that cloudiness, get through to a good decision by unpacking some of the biases and focusing on good routines, good discipline that are going to help you focus on the data. And behavioral finance is essentially a group of studies, academic studies, practical studies that describe why we make decisions the way we do, and then hopefully prescribe some ways that you can alleviate some of the negative impacts. And for me, I found that technical analysis, visualization, charts are one of the great ways that I've found to try to minimize the impact of those biases, focus on the evidence and focus on the right decisions.
So now I'm in the financial newsletter industry, basically all my life. My late dad ran his own investment company for 30 years. And in our business, at least, from our competitors sometimes, and not talk bad about them at all, but a lot of their business models are based on fear. In other words, they know by scaring the hell out of everyone, this is going to lead to more sales and more decisions. So, everybody's going to buy gold at all times because eventually the dollar's going to disappear, whatever, which, again, is crazy in my mind, but it does scare the heck out of people. For me, I'm so surprised because I'm a data-driven guy as well. And I don't call myself a perma bear or a perma bull. I just look at the data and let the data dictate what, I'm recommending to my subscribers. Do you track stuff like this because it's such a big deal and it influences the market, even if, say, the last 10 years, gold has not been the best investment? It's been fantastic lately. But it seems like people don't even really care about the data. They just get hooked on, that behavioral and conditioning where they're just going to make sometimes irrational business decisions because they don't want to look at the facts, look at the data.
You hit on so many really good points there, Frank. And you hit on, I think, a key point, which is that fear sells. Right. So fear is a great motivator for you to separate yourself from your money, to be honest. And I think a lot of people traditionally have described the emotional state of investors as fluctuating between fear and greed. Fear, pushing us downwards, greed driving us upwards. And I would argue that now, whether it's marketing or just the overall state that people are in with the recent, bear market movements that we've had in the last 20 years, it's sort of fear drives all of it. So it's fear of losing everything on the downside. It's fear of losing your shirt, your boat, your nice private school because you've hung on too long. But on the upside, it's no longer greed. I think it's fear of missing out, the FOMO that a lot of people are talking about. So it's expecting or assuming that others around you are getting better returns because there's somewhere where you're not. And if that's how you go about your investing decisions, driven by that fear, you are going to fall victim to so many different things, products that aren't really well suited for you, but also things like trading way more actively than you should, not paying attention to long-term trends, getting caught up in the short-term movements. And that is the recipe for, just losing a lot of money or making it a lot harder for you to make money. And I would say the other thing that you hit on, which is absolutely right. One of the common biases that I've seen, we call narrative bias, which is essentially, as humans, we love the narrative. We love a story. So forget about all the data. We want a clean narrative that explains stocks are going to do X, bonds are going to do Y, gold is going to do Z, because that's how it should be. That's what's normal. And we get so caught up in that narrative that we make bets based on that story and how that story should play out. But you know probably better than I do that the markets are not a simple mechanism. They're complex, and there's so many moving parts. And just right now, you think of the headlines that have driven the markets in the last couple of weeks, it's been all over the place. It's been a ton of different things. And so what you don't want to do is focus on a narrative, come up with a idea of what should happen and then make a bet that way. You want to focus on the data, gather all the evidence. And I always tell my clients, think about casting a wide net, gather all the data you can, and then start to make decisions about where you should be positioned. Because something like gold, people just sort of count it out in their head. They think, well, gold clearly wouldn't work right now because of XYZ. That's a narrative. If gold is working, then I'd want to be in gold. If stocks are working, I'd want to be in stocks. But that assumes that you're following the evidence and following the data, which is really, really important.
Now, you brought up a good point here because you said fear of missing out, FOMO, we see a lot. From your experience, and I know this might be hard to gauge, but I'm just curious, because I know you look at stuff like this, I think, but do you see a bigger fear from people when it comes to, say, what I talked about earlier, where hey, you got to get out of the market or you got to be in gold? Or is it a bigger fear from, hey, I'm fear of missing out, where you may make money on something, but you're not all in on it? And that, to me, I see that being a big risk. Is it one like trumps the other, or is it kind of like, all in the same ballpark?
So, there's been a lot of academic research trying to unpack this. And, this thing called prospect theory, which basically deals with how we interpret gains versus losses. And I'm generalizing a great deal here, but it makes sense. And so the short answer is what studies have shown is that we feel the pain of losses more than we feel the joy of gains. So the fear of losing money is the ultimate motivator. And I would say there's a number of ways that manifests itself in stock prices. And the way that I always, one of the ways to think about it is people have said that the market goes up the stairs, but goes down the elevator, right? So it goes up slowly as people accumulate positions. They feel more confident. But when things really get bad, you don't kind of get nervous and kind of lose a little bit of your position. You panic and you sell everything very quickly. And that's why the chart of a stock looks a certain way, because it's accumulation on the way up and then quick distribution as people take profits or panic, and the market will move down on average more quickly than it will go higher. So people have that fear of losing. But again, I think, to my earlier point, I would say that I'm finding fear of being a broad motivator, and I think on the upside as well as the downside. Now, maybe one of the best places to see that is with something like Bitcoin, which there's very little fundamental data on. It's much more driven purely on the emotional state of investors, a lot of speculation, not real concrete, fundamental data. And so as a result, there's a huge volatility, huge percent swings, and it will go up and down very quickly depending on sort of the flavor of the day and what people are feeling. So I would say more and more we as technical analysts are seeing timeframes compressed as the market is able to react more quickly to information because it's more widely disseminated now than it was before. And also, I think on both the upside and downside, you're seeing quicker moves and fear being a real motivator on both sides of up and down markets.
Yeah, and you're pretty good when it comes to this technical analysis stuff, right? I mean, you're a chartered market technician. I guess, why don't you explain to everybody exactly what that is?
Sure. So there's an organization called the CMT Association. I sort of describe it to people. It's the sort of the CFA for technical analysis. So there's a CFA that certifies professionals as understanding the fundamental process and value in companies and management teams. And the CMT was created in the early the organization was in the early 1970s. I think the late 70s, early 80s, they came up with the CMT designation. And the SEC at the time and FINRA now is sort of determined that the CFA and the CMT qualify professional analysts to have an opinion based on fundamental or technical data. And so, earning the CMT is essentially a, 3 exams worth of a boot camp on all things technical, sentiment, breadth, behavioral finance, quantitative analysis, statistics, all the tools you should need to make an opinion based on analyzing the visual data, analyzing the charts. And so the organization for me has been a fantastic part of my experience in the industry, both just from networking and meeting others that were looking at similar data sets. But then I joined the leadership. I was president of the organization from 2010 to 2014, which led to a lot of really cool discussions with some of my mentors like Ralph Acampora and Alan Shaw, Luis Yamada, and some that had been analysts well before many of us were investors or even born. So it's certainly been a fantastic learning experience and a great way to learn, really the breadth of the technical toolkit.
Yeah, that's really great stuff. I mean, that's fantastic. Obviously, I was being sarcastic when I said, a little bit about technical analysis because I know your background. But yeah, no, it's definitely very, very impressive. Now, here comes, well, so far the questions haven't been too tough, but I want to ask you this. Sure. Could you take me through an example maybe in the past? This way, because I know the investors love this when they look at methodologies and how people find new ideas. Sure. But can you take me through maybe a good example of how, monitoring trading behaviors using behavioral analysis combined with technical analysis had led to great returns on investment, like how the whole thing would work? And, you can use a past example, but how you would, use this methodology, which has worked for you such a long time. Could you go over an example of how it worked? This way people can maybe understand it a little more, maybe how to use it themselves.
It's a great question. Happy to do it. I would say, there's a lot of different ways to use technical analysis, to use charts. And the way I would introduce it is think about what the data tells you. So, if your time frame as an equity investor is short term, a couple of days to a couple of weeks is what I would put in that bucket, then in general, we should be betting on mean reversion, meaning, buying weakness, selling strength, because on that time frame, things tend to fluctuate back and forth pretty quickly. If your time frame is medium term, so I would say a couple months to a couple years, then you should be a trend follower. Again, all else being equal based on the data over multiple decades, that's what tends to work, meaning you want to own stocks that are working and you want to underweight or not own the stocks that have not been working. And then if your time frame is longer than that, a couple of years beyond, then you're getting into sort of the business cycle and more back to the cyclical, sectors coming in and out of favor and things like that. And you should be back to, thinking as a contrarian, as a mean reverter. So for me, those first two timeframes are really the sweet spot for technical analysis, because once you get further out a couple of years, I would argue that stocks trade to the fundamental valuations. That's totally fair. So if you're hitting 5 years, 10 years down the road, you should be really thinking about, those big secular themes and companies that are going to last for that period. But if you're down in the first two timeframes, you really want to be thinking of long-term uptrends. So I look for things that are strong in the last 6 to 12 months, but then weaker short-term trends. So something that's pulled back in the short term. If you think about it, what that does is it combines those first two timeframes. So something that's been strong. It's had a long-term uptrend, meaning there's a good trajectory to the upside. But then in the short term, it's pulled back. So you're not buying into a vertical market. You're buying into something that's more reasonable. So what comes to mind with something like that? Just thinking of something out of nowhere, a stock like American Express maybe makes sense. And thinking of the chart, and the good or bad thing about being a technical analyst is if you look at enough charts, you can bring them up in your head without seeing them anymore. It's a little strange, but it happens. So if you think of AXP, that's a stock that bottomed with the rest of the market in late 2018, sort of that December period, rallied pretty well, and it's been in a pretty good uptrend for the last 7-8 months. But probably over the summer, I would say maybe April, May, June period when the market sort of pulled back. American Express pulled back a little bit as well, pulled right back to its 50-day moving average. And there are a number of different ways that you can track short-term and long-term trends. And I have a number of more systematic rules-based ways that I sort of determine if a market's in an uptrend or downtrend over those different periods. But, subjectively, if you look at AXP, you'd see long-term uptrend in the first half of 2019, pulls back a little bit to its 50-day moving average. Besides that short-term pullback, everything else looks pretty good. It's still a strong uptrend. Still showing signs of accumulation. And again, if you buy when a stock like that pulls back to its 50-day, it tends to do pretty well. And what's happened since then is that was a good entry point, continues higher. So again, something that scores well on the long term, scores weaker on the short term. And most institutional quantitative models have a momentum factor, and it's usually based on something similar to what I just described, like a 12-month return minus 1 month return, or something like that. And it's based on the data and sort of like the simple example that I just explained with AXP.
I love that you explained it, because I've had people who do trend following and write about trend following. And whenever I question them on something, they just simply say, yeah, you're buying what's working and you're getting out what's not working. I'm like, that's pretty okay. But could you explain? Because when is something considered not working? Because you could look at FANGs, which worked for 7-8 years, and you could argue that maybe it's not working as much, where Amazon, Netflix have sold off, where the Googles and Apples have outperformed them a little bit as of late. But, putting technical analysis with it, what you just did, I really appreciate it. But I don't know if you hear the same thing about trend following, but I'm glad you put technical analysis because, like you say, it's a very big deal to combine those, right?
That's exactly right. And to be honest, technical analysis, I mean, I started in the industry in 2000, so I've, about 19 years in, but even when I started in 2000, hedge funds had grown and become more and more popular, but technical analysis still was very, was not widely used in the mainstream. It was considered, sort of a pariah sort of exercise. And a lot of people wouldn't admit, and still to this day, I'm sure some investors wouldn't openly admit how much that they use technical analysis. Although I would argue that more people look at charts than you would expect based on the time I've spent with institutions over my career. But if you think about it, what's happened since then, there's been more and more academic research showing that momentum works and that trend following works. And the first study that I have ever seen on it was actually from the 1960s. There's a paper by this gentleman, I think Robert Levy was his name, Levy, and he wrote a paper basically explaining relative strength, buying stocks that were outperforming, underweighting stocks that were underperforming over that 6 to 12 month period. And he showed over decades that it kind of worked. And that factor, that momentum factor has continued to work. Even to this day, as more and more people know what it is and are betting on it, it still seems to work. So trend following absolutely has stood the test of time. And I think, keeping that as part of my toolkit has been an important part of it for sure.
So with your experience, you've been doing this since 2000, all the groups that you're in that allow you from technical analysis perspective to pick the minds of some of the greatest guys out there that have been doing this. What are the changes that you've seen? Because for me, I am more, I wouldn't say fundamental analyst. I do look at charts a little bit, but it's becoming more and more part of my methodology because you have the renaissances of Six Sigmas, the high frequency trading firms, algos that get in and out immediately. Has this changed the way you look at technical analysis? Do you have to adjust for this? Because, today with the algorithms, I mean, you'll see companies report bad earnings and open up down 3%, at the end of the day, down 15%, and then it'll bounce right back. But it's like the algos, it's just all its volume comes in. But I wonder if have you looked at that or talked to some of the great legends out there where that's become a bigger deal because you have to focus on that now. I don't care what analysis of your fundamental value growth, you have to start looking at charts and looking at these things because when they break these levels, it seems like it's more accelerated to the upside and downside today and the past couple of years than it's ever been. I've been doing this for over 2 decades.
It's a really, really good question. And the short answer is absolutely. The world has certainly changed in the last 20 years, to say nothing of the last 50, 100 years. I mean, the markets have evolved, and I think the pace of change has certainly accelerated. So I ran the technical team at Fidelity from 2008 to 2016, worked with all the equity fund managers there, and I had a chance to spend time with one of my predecessors. His name's Bill Doan, and isn't maybe a name that some people are familiar with, but he ran the technical research department, including the chart room at Fidelity, sort of the late mid 70s to early 80s would be my guess at that time frame. So this is during the 74 low. This is during a really tumultuous period, and then the 82 bottom, the 83 breakout. I mean, a really fascinating period of market history. So I had a really good time talking with him about it. And, the way he described it was the world was very different in that there was a huge information edge at a large firm like a Fidelity. And they, still have a huge chart room with wall-sized paper charts going back hundreds of years on equities and breaking down different assets, some really, really cool stuff. But at the time in the 1960s and 70s, just no one had that because the only way you would be able to chart stocks like that was to have a team of people that spent all of their day literally charting. And, guys that came before me, they actually called themselves chartists because they literally created charts for 90% of the day because you had to do it all by hand. You had to do it by pencil and paper and looking up the data and updating the charts. Now what's happened, as you know, is that, information is more widely disseminated. There's not a huge information edge. So the edge I think you can have as an investor is not trying to know what other people know in terms of fundamental information, because I think everyone will know that. It's knowing the data and knowing the relationships and identifying an opportunity or a divergence, an outlier in a way that others won't. And for me, charts have been the way that's been the case. And they were, my predecessors were doing that 50 years ago. We're doing it now. It's just the toolkit has changed. It's all electronic. You can screen for things so widely. So if you figure your universe is 10,000 global stocks that you could buy or sell on any day, screening on technical inputs, breakouts, and significant volume and different things, that's the way you're going to surface the best ideas to the top of a big list much more quickly and much more efficiently than you could by looking at a bunch of 10Qs and trying to find good stories, with individual companies. To say nothing of the fact that ETFs have been the biggest game changer in terms of your ability as an investor to have exposure to themes and market cap ranges and global regions in a way that you never could before. So I think, again, charts are a really cool way to look at a broad universe and just see what's working and what's not. Where are the movements? And regardless of what the U.S. equity market is doing, there is always something out there that is breaking to new highs, and there's always something breaking to new lows. So I do a lot of screening on 13-week new highs and lows and other sorts of things just to pay attention to where the movements are. And then you dig into those stories and see where the opportunities are. So I think our toolkit is, richer and more dynamic than it's ever been, which is really, really exciting.
So based on that, is there anything, and this may change by the time we finish this conversation, but based because when it comes to technicals, but is there anything that you're seeing now, right? That maybe, like even a sector, because I know the transportation companies have, broke through new lows, which is kind of a signal like, well, maybe a recession's here again. There's not too much proof in that, but that's what you hear out there. Sure. More money into consumer staples means it's safety, more money into gold, same thing. But is there anything that you're seeing like over the past, day or two, because, we're dealing with this, big sell-off and kind of nervousness in the market that, like you said, there's always a time where there's things that you could buy or things that you could sell, things are not working that you can make money off of, or ETFs Sure. and stuff. I was just wondering if you had anything that you're looking at. It's a tough question because I know that could change completely by the time people listen to this, which is going to be tomorrow.
Yeah, that's right. It's exactly right. And obviously we're in a period of a lot of movement and a lot of rotation. So seeing where the dust settles, I think, is most important. So when the market sells off like this, we always say, don't confuse brains with the bull market. So when the market's doing well and your portfolio is appreciating, it's easy to, pat yourself on the back and feel like you're kind of getting it done and your process is solid. But when the market turns down and you start to see some paper losses and you start to, feel some uncertainty, that's when your process really needs to be stable. And that's when you really need to have some ideas of where you would reconsider position. So I always am, looking at levels or movements that would cause me to change an opinion or cause you to reverse thing. What's going to cause you to revisit something. So you hit on a number of things that I think are pretty interesting. The two ratios I would say that I follow the closest are, offense versus defense within consumers. So just the ratio of consumer discretionary versus consumer staples. And, again, generally speaking, that's going to do well in a bull market phase. It did really well in the first, quarter of this year. As the market rolled over, April, May, that ratio turned lower. It's been holding up pretty well, but it just turned down a couple weeks ago. So before the markets really started to sell off, into this week, that ratio had actually started to reverse a little bit, which for me was sort of a, look, if staples are starting to do better, that's the kind of environment that I'm not feeling great about, much further highs in equities. The second general thing I would say would be the relative performance of semiconductors. So that's a group that tends to do well in bull market phases. It tends to underperform in bear market phases. That ratio had almost gotten back to new highs just a week or two ago. It was back up to the levels from the end of April, and it just quickly has now reversed higher. So it didn't break to new relative highs, telling you there's less momentum for semiconductors. That's sort of a macro worry. And then the third thing, maybe if I'd throw in, would be breadth. So, there's a lot of ways you can measure the breadth of an advance or a decline within the equity space. One of the things I would look at is the percent of stocks in the S&P 500 that are above their 200-day moving average. And, again, if you think of the 200-day moving average as a simple long-term trend following device, looking at what percent of names in the S&P 500 are above or below that level, a lot of times will tell you, just give you a sense of how much stocks are participating. That was up around 75% maybe a week or two ago. And it's already down to probably 55, 57%, which means, it's down almost 20 or so percent just in a week, which is a lot of stocks breaking down through a key long-term level. And if you look at the 50-day moving average, like the example with American Express we looked at earlier, that was up to about 85% and is now down to 25%. So 60% of the stocks in the S&P, big, large cap names, have rotated below the 50-day moving average, which is kind of that first trigger telling you to be a little more cautious. So that rotation and breadth that's happened, confirms that this is, this has certainly been a corrective action. And now the key is looking at all of those three things that I just mentioned, the consumer discretionary versus staples, relative performance of semiconductors, and then breadth in the S&P, and seeing if it breaks down through levels that it tends to hold in a bull market correction. If it breaks through those, it tells you it might be more of a steeper decline going into the fall. So that remains to be seen.
Now, you broke a lot of the technicals down just now, and I want to know for me, right? Because usually I like to ask questions. I think my audience like this is actually personally. So when I'm looking, it's almost overlaps when I'm thinking about it, because I have when you're looking at behavioral analysis, I guess what are the key indicators you look for that? Because you just mentioned technical indicators, but what about volatility? Because not volatility, I'm saying volatility might be one, or money moving out of the markets into bonds. Are those indicators where, and even, I mentioned, RSI, which could actually be both, I think, right? Technicals and also behavioral. But for me, I look at CNBC and I'll watch TV. And the reason why, and I'm not picking on these channels, I like them, they have good people, but it lets me gauge sentiment, and it allows me to really come on here at my podcast and tell people, hey, this is what you really need to be listening to. Because sometimes, they get to extreme levels and that's their job. This way, you get more people watching. So
that's right.
A long-winded question there, but what are some of the indicators, I guess, that you look for when it comes to determining behavior?
Such a good question. There's so many things that I could answer with, and I would start off by just agreeing. I've always, my toolkit, there are a lot of different parts of the technical toolkit. That umbrella has a lot of things underneath it. I've always gravitated toward things that fit a couple criteria. Number one, something that's testable, meaning I can determine, I can test over time how effective has this been, which is no guarantee it's going to work going forward, but it gives me some, sense of its capabilities in different market regimes. So some sort of testability. The second thing would be provability, meaning why would this make sense? It has to resonate. So, if an indicator tests very well, but I can't explain to my mother, here's why it makes sense to use this, then you probably don't want to use it, because it means you're making things way too complex. I like things that are simple to understand, simple to interpret, simple to test, but also simple to explain and understand. And if something can sort of check all those boxes, it's something you want to use. So having said that, I would share two things. One is you'd mentioned RSI, which is the relative strength index, simple measure of momentum. And I use that all the time. If I have one indicator on a price chart, it would be the RSI at the bottom, because what it does is it essentially takes a z-score of the price returns. If anyone that's statistically minding, meaning it takes all the movements out of the way and just looks at the relative movements. How much does this stock tend to move and how much is it moving right now? So what's happened with the S&P just in the last couple of days, we've had the huge sell-off into the beginning of this week. The RSI went below 30 for the first time since the beginning of June of this year. That only happens when the market has come down a lot. Just by definition, that's what it tells you, statistically. So the question is, when it gets to that level, is this a short-term bounce, which, today we're seeing on Tuesday the 6th, but, that could be just what we call a dead cat bounce, just a quick, reaction move before we continue lower. And looking at RSI is one of the ways that you can determine whether, how much are people reacting to, the Fed and China and all these things that are happening. The price and the RSI tell you that's something quantifiable. That tells you what are people doing, how are they voting with their feet or voting with their money, and that's how you can start to quantify fear on one side or the other. So that's something I'm looking at right now. From a more subjective standpoint, perhaps you sort of hinted at this idea of contrary opinion. And years ago, my predecessors at Fidelity and elsewhere would look at magazine covers. So, the death of equities came up in the late 70s, just before the biggest bull market in U.S. history. When the market rallies to the peak in 99, 2000, all the tech companies going vertical. You had GetRich.com and the New Economy, the New America, all talking about, tech companies going up forever. And that was pretty much the time to be selling technology. This has happened through multiple regimes. The housing bubble, you had, housing stocks going, up forever. Your home is going to be the new equities. And all of those things tend to happen. And in a shorter term time frame, you could measure the same thing with newspaper headlines, with financial media, financial TV, and the simple thing is, if there's bright red on the screen or bright green on the screen, that will mirror the general market movement and the general sentiment of investors on a short term basis. So if you want to see where to bet against, I would be looking for the brightest, boldest, craziest new logo that's created to identify a theme. That's usually when you want to start thinking of the other side and thinking about risk management for that play. So contrary opinion can be really, really powerful, and looking for extremes in sentiment can be really powerful. My concern with something like magazine covers or, headlines and such is how testable is it? And, how consistent can that be? And anecdotally, I like to look for examples of that, but then I'll always go back to the data to try to qualify it. Am I seeing some extremes in price movements or in momentum that would help qualify or, confirm what I'm seeing with sort of the general media approach to something?
Yeah. You know what you could add to your list, which is a great indicator? When I used to work on Wall Street, so I worked right across from the stock exchange, street.com, for about 5 years. So every time a company would come to ring the bell, they would display certain things outside. They'll have a banner outside, which is standard. But some companies, it was like, and we used to joke about this with the analysts that were there. I think it was an ethanol company. They had this 18-wheel truck. They had pretty much 100 people dancing in the streets. And I was like, all right, just short the stock.
That's it. Yeah, right. Yeah, the one of my mentors at Fidelity, one of the former portfolio managers, said he was at a technology conference in like 99. And I mean, this is when things were just going absolutely crazy. And he was at one of these trade shows that had ballooned from like 20 attendees to like 20,000 in a couple of years because there was so much interest. And he looked where the bathroom was. And he said, I literally could not get across the trade show floor to get to the bathroom. And he's like, and I walked out and started selling my positions because he's like, this is way too much excitement for this theme. Like, that's it. So there, you're right. There are some really good anecdotal examples that are just really, really tell the story of the extremes in sentiment.
Yeah. And one last question here, because I know you mentioned earlier that, you coach investment professionals, hedge fund and money managers. I think you may be the third or fourth person on here that said that this is one of the things that you do. And it's surprising because this is the past 18 months where it seems like this has become a pretty big business, pretty big industry right now. Talk a little bit about that, because hedge fund managers, I know a lot of them, people that manage money, they have incredible egos. They always think they're supposed to have incredible egos. I'm not saying that's what you want. If you're investing in it, you want that guy to be totally confident. But yes. You don't see too many of those guys taking a step back and saying, hey, I need help. Talk about that process.
There's a reason why most 12-step programs start with number one, which is admitting you have a problem. And there's a reason why you start with that. And you're right. I mean, there's a bravado, there's a confidence that resonates with most money managers, I think out of necessity, because you have to do it. And, again, I've spent a lot of my career coaching professional analysts and employing them and mentoring them. And I found that, you coach people to pound the table, have an opinion and really drive it home and get people to buy into it. And the problem is when things start to go against that idea, when you start to have trouble, you're not really equipped to deal with that. And, we often prepared the new analysts when they would arrive that, you're used to going to school and getting good grades and being right 90% of the time, getting an A. Here you're in an industry where you're going to be right just over half the time, probably, which means almost half the time you're going to be wrong. And you're going to do a great work and you're going to do a thorough job. And the market's just going to move against your position. It's going to be the wrong decision. And, winning in this industry is not about having great wins. It's about minimizing the bad losses and making sure that, small losses don't become larger losses. So, for me, I think that's the biggest hurdle to get through with people. And, using social media and other educational platforms, I've tried to find people that have an openness and a willingness to admit that there are some weaknesses in my process, because, what we essentially do when we start working together is work together, right? How are you, what are you looking at first thing in the morning? What's your daily routine? How often are you checking positions? How are you incorporating financial media, blogs and stuff in your process? What information, where are you getting all your data from? And during the course of that, you find all these little pieces of opportunity for improvement, places where it's inefficient or, you just have some bad habit that's developed. And, again, finding, I think the courage to, reconsider some of your shortcomings is probably the biggest challenge for that most of investors will have. But, again, the best investors that I've gotten to know over my career are the ones that are open and honest and have a process, either a natural or a deliberate process where they go back and, think about what's gone well and what hasn't. And I'll finish with one quick anecdote. One of my, favorite managers to work with, once a year, at the end of every year, he would look at the S&P 500 stocks over the last 12 months. What were the 5 best performers and what were the 5 worst performers? So in my benchmark, what 5 names were the best ones to have owned and what were the 5 that were the worst to have owned? And did I own any of the 5 top stocks? And if so, great. If not, what did I miss? Right? What was there in the theme, in the story, in the chart? What could have gotten me into that top performer? And then the same thing, did I own anything toward the bottom of the return list? And if so, like, what did I miss on the downside? Where's my risk management, process sort of have some gaps in it? And by doing that regularly, once a quarter, once a month, or once a year, you'll start to identify some potential places where you can make some improvements. But you have to have the humility to even have that discussion. And you're absolutely right. I think if more investors had that humility or had that self-awareness, probably, I would say, they'd be better for it, for sure.
All right. So great stuff. I'm going to end with one last question, which this one is probably more important than anything we talked about today. I guarantee it. Okay. I guarantee it. Is Ohio State going to win the college football championship?
I love this question. I'm a huge fan of this question, Frank. Thank you for that. I thought highly of you, but you went up just a notch right there with that question. As all college football fans, my team is undefeated as of right now, so I will ride that momentum until it ends. But that is a fantastic program, and I'm thrilled to be following it. I would say so. I'm in Cleveland actually at the moment, and I would say that there's more of an excitement for the Cleveland Browns than I have ever seen since Bernie Kosar days in the early mid '90s, or late '80s. So there's an excitement for a number of sports teams here in Ohio. So I'll take it.
Yeah, Mayfield chugs a good beer too. I don't know if you saw that.
Yes. At the Indians game. That's great, right?
Which is great. And I saw that you went to Ohio State. There's no way anyone goes to Ohio State without being a total huge football fan. So I'm glad
that's pretty much a requirement. That's unavoidable. And my father-in-law actually took a football coaching class with Woody Hayes in the early 1970s. So no joke, is a true story to ask my wife's hand in marriage. I literally had to take an Ohio State football test on play calls and all sorts of stuff. And my wife and I and our two children now, I passed the test.
Oh, that's great. That's great. Well, David, listen, usually these interviews go 20 minutes or so, went longer because we just had so many great topics. And I really appreciate you coming on. I love what you had to say, educating my listeners, and open invitation whenever you want to come back on. I love what you had to say and really appreciate you coming on.
Appreciate it, Frank, and congrats to you on the podcast. Things seem to be going real well, and yeah, I'll certainly keep you a listener.
Thank you, I appreciate it. Wow, great stuff from David. I really enjoyed that interview. He covered everything. I love that he explained everything in detail. He's not just throwing out things out there. He told you what RSI is. For me, I want to learn more about the difference between behavioral and technical, right? Because if you saw even the questions I was asking, it's things that overlap. But there is a lot of truth to behavioral. Like I said earlier, I watch CNBC just to gauge what sentiment is. You can go to stores, you can go out. There's so many different ways. He brought up those magazines, which are great. You could time that perfect. Like the .com is here, or don't buy equities, whatever it was in the 70s. So, here's someone that's been doing this for a very long time, knows some of the best people in there. To me, came across as just like a humble guy that's trying to help investors. And I love that. These are the type of guys I want to bring on. But again, this podcast is not about me. It's about you. Let me know what you thought. FrankCurzioResearch.com. That's Frank at CurzioResearch.com. And yeah, David's just another great guest that we had on with Ken Fisher, Meb Faber, Rob McEwen, found a Gold Corp. We had Steve Kumar, great take on trade in China. Now David Keller. Next week's going to be another first-time guest. He happens to be the CEO of one of the biggest security token exchanges in America. I'm begging you to please understand that trend because it's going to be very big. It's here. It's not coming. We were early to the party, which is perfect timing now. It's great. Everything's got a piece of the puzzle just fitting perfectly right now, which is awesome because we closed our security token, Curzio Equity Owners Token, on the 15th of July. So really exciting stuff. And we have investors in our company. I gave you direct access, but he's going to talk about that industry. Nobody knows about him because, again, I won't give you the name. You could probably dial it down to about 5 or 6 different people who it might be, but he is the CEO of one of the most biggest security token exchanges in America. But getting back to the point, I just want to say thanks because, a lot of this is spreading word of mouth and it's getting bigger and bigger. And because of that, we're getting a lot of high profile people and great guests reach out to us to come on the podcast, which is, I have to say, this year has been the first time. We've seen that sometimes, but not overwhelmingly the big names and billionaires that want to be interviewed in this podcast. So they see this as a platform. They see that, a lot of people listening, and, I just want to thank you guys. It's because of you and spreading the word. And that's really cool stuff. And I'm hoping to get Kyle Bass to come on, which might happen because I think he's a really smart analyst and I think it'd be a good debate and just to talk to him. So I'm trying to plan that as well. And hopefully we'll get him to come on and a lot of great guests going forward. So moving on, let's get some educational segments since podcasts run a little late. I do like to keep those, I wasn't lying, to 20 minutes, 25-minute interviews. But when things are going great and it's just, I'm getting more, just stuff that I think you can learn, I'm going to ask more questions, and I'm going to try to keep those guys on as long as I can. And I appreciate that David stayed on. That was, I think, over a 30-minute interview, which is really cool. But getting to educational segment, right? We talk about China. I talked about in the opening, China-U.S. trade, biggest topic in the markets right now. And, we're seeing the markets pull back. They're bouncing up a little bit. And remember, David said, we did the interview Tuesday. I tried to do interviews Tuesday and Wednesday, even though they come out Wednesday. But these are high-profile guys. They're not available on Wednesday at 4 p.m. just before all the time. Sometimes I'll have to tape them Tuesday, but I wanted to make that clear to you really quick because he is a technical guy and things could change. And he recommended a few things, but that was Tuesday. Today's Wednesday. So when you're looking at the markets here and everything going on with trade, you're seeing. I'm seeing so many great opportunities. And if you're looking at small caps, widest gap in terms of performance relation to S&P 500, 10 years. So they're significantly underperforming the markets. Now, when I look at the markets, are there factors that could push us lower? Absolutely. Maybe we just start getting some really weak data on the housing front, on consumer spending. Although this may be viewed as a positive, since it's going to give the thumbs up for the Fed to lower rates, right? So bad news has now become positive, even though the Fed has to lower rates and they will lower rates no matter what, just based on where bond yields are, corporate bond yields. Maybe, housing tails of tensions worsen in China, Brexit. Trump tweets on negative, trade with Europe or other countries. That's always a wild card. I think I read a Morgan Stanley report highlight like 10 negatives, 10 positives. And out of the 10 negatives, like 7 of them had Trump's name in it, which I thought. So I was like, if Trump just shut up, maybe, this market would be a lot higher. But I just thought that was funny. But after the recent sell-off, I'm really seeing some amazing opportunities. Like I said earlier, I see no signs of a recession. It is based on the data. Stocks are not expensive. The Fed's going to lower rates going forward. We're heading into an election year, which is usually great for stocks. Just it doesn't suggest that we're going to have a recession, at least over the next 12 months. I don't see it. I don't know. I haven't seen anyone convince me otherwise. Doesn't mean it can't happen. And again, I'm looking at the data, but right now it's still very positive where, it's not great, but it's definitely not, recession. So I can see the market bouncing back just like it did. And we are probably going to see that. Again, we're getting into election years, a lot of positives, and we've seen this before, and I've gotten emails and people get worried and get crazy, and I get it. But I look at companies like Intel, which blew out their numbers and raised guidance a few weeks ago. That was when the stock was at 53, 54. Now it's at 47, only because of the market. Amazon at 1750. Quarter was decent, but massive growth ahead for this company, firing all cylinders. You look at the chip sector breaking down. If you look at transportation, I really like transportation. Trucking, shipping look very attractive from a value standpoint. And I understand that value is not in favor, but also from a growth standpoint. You're seeing growth slow in that industry, but there's a lot of good names that are going to see growth based on a lot of catalysts coming up over the next couple of years. I think I thought these things were great buys. I've recommended one that I think we're doing okay on, considering the rest of the market has come down. And, we basically, I think we're going to make a lot of money on that stock for Curzio Research Advisory. So anyone who's a subscriber knows exactly what stock I'm talking about. But when I look at some of these names, I thought they were buys 10, 15% ago, and they're down even further. Again, you want to wait for the trend to change a little bit, get a little more positive, but seeing a lot of value there. I'd stay away from energy. It's just these companies have too much debt right now, and I think oil prices have to go a lot higher. You'll be safe with the Exxon, Chevrons reported good earnings, Devon, Pioneers, and stuff like that. Mid-cap, smaller names, just be careful there, guys. These guys have a lot of debt that they rolled over in 2015 when they almost went bankrupt. Then oil prices bounced back, but now a lot of that debt is due. And, these guys pedal to the metal right now where they need to produce as much oil as possible, which more supply is going to push prices lower because they need to pay off their debt. So it is a very dangerous industry. I'd stay away from that. Software names pull back a lot. Some great names in that area. And, I'm seeing the sector. I would definitely, if you want a game plan, that's what I wanted to go over you with real quick. If you want a game plan, look at small cap names that blew out earnings, and start doing your homework on those, because not only they blow out earnings, a lot of these companies are seeing steep sell-offs because the Russell 2000 is just being shorted like crazy right now. And you're seeing some of these names that don't even have exposure to China down 20% after reporting really strong earnings and also raising guidance. I'm not going to give away too many names, but I have dozens on my watch list that are going to make their way into my portfolio. So Curzio Research Advisory, also Curzio Venture Opportunities. So I suggest looking for names that reported solid earnings that sold off. Make sure you look at their guidance, which is all that really matters. I mean, you can report great earnings. If you lower your guidance, stocks can get crushed. Vice versa. If you raise your guidance and you miss earnings, that stock's going to go higher. Like we saw with Take Two, which is the name of the portfolio that we're up pretty nice on in Curzio Research Advisory. But look for companies that raise guidance that maybe also, or maybe that didn't raise guidance. So maybe they beat the quarter and blew out the numbers, which means if you blow out the numbers, you would raise guidance, right, for the year. But a lot of companies aren't doing that. They're being conservative because of the geopolitical risk. What's Trump going to tweet today? And it gets crazy where, some of these companies do have supply chains still in China, and, the latest tariffs has really crushed a lot of retailers and stuff like that. But see if they're being conservative with that guidance, and also look at the valuation. Are they cheap? Which could sometimes be a negative, guys. Not always positive. If stock's cheap, it's cheap for a reason, right? Because it's probably not growing. But if they're not cheap, but a little bit expensive, do they deserve that premium because of the market they're in? Like maybe software, social media, AI, big data, Internet of Things, all these trends that I've covered numerous times over the past few years. But trust me, especially when it comes to small caps, I've not seen this many opportunities for at least 2, probably 3 years. And I'm loading up my personal portfolio right now. It's just a lot of these companies are sold off unfairly, and it's creating a good buying opportunity. And there's also a lot of money in the sidelines I think is going to come back in once this trade thing really dials down a little bit, which, eventually it would. And if it doesn't, I think we're still going to be okay. There's just too many factors that are going to be positive with Fed's low interest rates. Earnings are still pretty strong. Consumer spending is still pretty strong right now. So that's my take on the markets. So using this temporary pullback as another buying opportunity, which I told you to do, again, I'm not patting myself in the back or whatever. I'm just saying remember those other times when, David talked about it, that fear that pushed you out of the markets. Well, we rebounded almost every single time after that, and every time after that. And I think the same is going to happen here. We could go down a little bit further, but start doing your homework now. Start looking at these names that just reported great earnings, that have sold off. Again, the guidance, stuff like that. There's so much to look at right now. Listen to this conference calls, but trust me, you're going to find a lot of really good ideas that are down 20, 25% after reporting fantastic earnings. It makes me think if they report a weak earnings, what were they going to go down? 50%? Just doesn't make sense. There's like a disconnect right now where people are just selling stocks and not looking at fundamentals. And there's a lot of hidden gems in there. At least I'm trying to find that are going to make their way into my newsletters. So that's it for me. Be sure to check out our token tracker site, which gets sent to you for free if you're on our list, which is our mailing list. So to get on our mailing list, just go to our website at www.curzioresearch.com, where you'll get access to even more free stuff, which we like to, especially people listen to this the first time. They're like, who is this nut job? I don't know him. He curses sometimes. I don't like his political views, whatever. But, that free stuff allows you to see what we're doing. And that's what we have to do, right? If you never saw us before, never heard us before, we like to give away some free stuff. So once you see it, a lot of you subscribe to our products, which is great. But other free stuff we offer is, we're going to send out alerts when Wall Street Unplugged is published, along with transcripts of the podcast, our weekly breakdown where we pull the best stories of the week, or stories that could actually make you money in the markets. And we send that to you, again, for free every single week. So some really cool stuff, which you'll have access to once you sign up for free, a mailing list at www.curzioresearch.com. So, guys, long podcast today, closing out here. And I try to say, put your emotions to the side. I know that's so difficult in today's market. When you're seeing shootings and all kinds of crazy stuff and just looking for people to blame or whatever, I get it. I do. I understand it. We just want answers. You may not agree with sometimes my sentiment, my political views in relation to the market, which that's why I use my political views for, in relation to the market, which is very important, how we make money and stuff like that. But whether you agree, disagree, just know one thing. I always have you back. I'm trying to make you guys money. I'm trying to steer you clear of all the BS that's out there, regardless. And I don't expect you to agree with everything I say, and that's cool. And I understand that. And I want to get feedback from you guys, because a lot of times I might disagree with you, but you may come up with something that makes a lot of sense and change my mind. And, it's all the better for it. So I really appreciate you guys listening. And again, this was for me, look at this podcast, strong opinions, but trade and things like that. A lot of people have it wrong. They've had it wrong for a while. I feel like we've been right on this so far. Although I thought there wouldn't be a trade war. And it's not a trade war, but I didn't think it'd last this long. But still, we've been able to really stay in U.S. stocks and do very, very well. And I think this is providing another buying opportunity. And we'll see going forward. I'm not right all the time, but I've been right on trade and in terms of getting you guys in stocks at the right time. And hopefully that continues, because at the end of the day, I just want to make you guys money. So that's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.